Ottawa, and our Finance Minister Bill Morneau gets set to introduce the this due to small business. What are the unintended consequences for small business? I mean, there's a lot of conversation south of the border by the U.S. President Trump. I mean, he's making it a lot more friendly to business. What do you think will be the unintended consequences of these proposed changes?
It seems that in the U.S. they're putting out a sign saying, "Come with us, we're ready to go." And in Canada, it's sort of a "stop here" sign. And there are really two consequences, and they apply equally to businesses that already exist that are struggling to get ahead, and also to entrepreneurs who are thinking about starting a business. So the first thing is that the proposals will undoubtedly affect capital formation, raising money. And the reason for that is that when entrepreneurs are successful, they usually like to invest in other entrepreneurs. And under the proposed regime, especially because it's a little bit gray exactly around the edges how it'll work, what you will find is that investors will be less likely to take long-term risk on other entrepreneurs if they think that the tax regime will be so punitive so that the likelihood of success will be lower. So conversely, if you have an existing business or you're thinking about starting one with your own money, you have to think in an after-tax world. So you have to think, if this works, and we know that at least 80% of new businesses fail, if we're lucky enough to have this one work, will I be left with enough money after tax? Because remember, the employees and all the other expenses get paid before the business owner actually takes his or her cut. Will I be left with enough to make it worth the risk? And so what we're talking about here is at least a doubling of the taxes associated with the small businesses when you think about the way the passive investment rules are proposed to work, which means that you'll be left with about half as much. And for a lot of people, they'll say, I think that is what tilts it against the concept of starting a new business at this time.
There's also the introduction of a possible minimum wage rate hike. How will that potentially affect small business?
Well, this is really the perfect storm. It's not just the concept of the minimum wage going to $15. A lot of small business owners that I've talked to, and a lot of them are very successful, by the way. I mean, you can have a small business that makes millions of dollars a year and employs 100 or 200 or 300 people, which is very important to the economy. They're really the engine of the economy. And what they tell me is, I want a living wage. I believe that my employees should be able to live on what they're paid. But one of the things that is forgotten about the minimum wage is that if you move the minimum wage to $15, all of the other employees that are currently making $15, $16 an hour will then want to make $20 or $21 an hour. And so that you see the input costs going up by 20 or 30% on the labor side, which already is like a tax. It makes it less efficient to run the business. So what you could say is that you've got the 1-2 punch. Is that on the one side, you've got the minimum wage going up, which is anti-business, but socially acceptable for a lot of people. And then you have the second punch, which is, and if you're lucky enough, notwithstanding the increased costs and the increased taxes to make it, you're just going to keep less. So it is not an environment that is conducive to continuing to run small businesses or to think about starting one. That's kind of the bottom line.
If, as you say, the U.S. president has put out that welcome mat, let's just say for lack of better wording, will this be more appealing to small businesses, to Canadian small businesses who, I guess, typically would pride themselves on the fact that, yes, we are Canadian and they want to, give back to our economy? This changes that whole dynamic.
It does, and actually we didn't talk about the third punch. It's really a 1-2-3 punch, which is the unknowns around NAFTA. Because right now, if you're a manufacturer in Ontario and you see the minimum wage going up and potentially your taxes going up, and you also are not certain that you're going to be able to export what you manufacture into the U.S. without duties that could come along if NAFTA is renegotiated, you think, why don't I just go to the U.S.? The U.S. is putting out the welcome mat. They recognize that their corporate taxes are far too high, and that has it's been really stifling in the last 10, 15 years in the U.S. as the corporate taxes are among the highest in the developed world, that you see other countries, such as Canada, which are bringing up and saying that we can create business-friendly cultures, and that's really being flipped on its head. And so I don't see any reason why, if you were starting a business or running a business, you wouldn't think about moving it to the U.S.
Talk to me briefly. You mentioned collateral damage. I say unintended consequences of restricting income sprinkling.
I think we can all agree that there are examples of income sprinkling which are probably unfair and need to be addressed. Truly unfair, even using Minister Morneau's definition of what unfair is, which is that certainly young kids should not you shouldn't be able to sprinkle to your young children. You shouldn't be able to sprinkle to your spouse if the spouse has absolutely nothing to do with the business and isn't making sacrifices to help that business move forward. On the other hand, if you, say, run a farm, or if you have a corner store or a small business where one of the spouses has decided to leave his or her job to be able to support the family while the other takes all the risks, it is unconscionable to me to think that you wouldn't be able to spread that income around and take advantage of the lower tax rates at the lower margin.
Using small business as a form of passive investment?
This is one of the most misunderstood parts of the proposed legislation. So here's how it is today. If you take two people, you have one person who's earning, say, $200,000 a year, and I'm going to use round numbers here, that they're going to pay half of that in tax because they're an employee, they're left with $100,000. You take a business owner who earns $200,000 after paying everyone else and without having a pension and all the other things that people have been speaking and writing about, and they're paying about 25% corporate tax. They're actually paying 15% on the first $500,000. So they're left with somewhere between 75 and 85 cent dollars. When they go to invest what's left, presuming they don't reinvest it in their business, they are starting with a higher base. That is true. So the question isn't whether they are equal or unequal to the employee. They are unequal. Those two things are not the same. The question is whether fair and equal mean the same thing. So my proposition is, it's totally fair to say to an entrepreneur who has taken risks with his or her capital, employed other Canadians, that should they be lucky enough to run a successful business, that they should be able to keep a little bit more of it and invest in so-called passive investments. And that forms both their pension and also their rainy day fund, because they never have any of that. They don't even have EI benefits. If the business doesn't work out, they don't have maternity leave. So they need to be able to build their own from a higher base. And that's the difference between fair and equal. Converting dividend income into capital gains? That is probably the one area that should be addressed. See, what's happened over the last number of years is that the spread between the dividend rate and the capital gains rate has widened dramatically. Now it's close to 15 points or more, which means that in the old days, when you would take a dividend out of a holdco and you'd pay the dividend tax of, say, when it was 30%, that wasn't that far away from the 25% capital gains tax that you would pay if you were to redeem shares from the same holdco. Today, as that spread has widened, what's happened is that accountants, being smart and doing good planning, have said, instead of doing the dividends, let's figure out another way to get the money out of the company that doesn't involve paying 40% tax. So the issue there is that whenever you have recharacterization plans, they have to be addressed, because in the end, that does affect the total number of dollars that are being collected by the government. And you want it to be on an apples-to-apples basis to be the same for both, because that is not a fairness issue, that is an equity issue.